market watcher Anthony Saccaro.
Anthony Saccaro here to help us is Anthony Saccaro, president of Providence Financial and Insurance Services.
Anthony, thank you so much for being with us.
Providence Financial's Anthony Saccaro is with us.
Anthony, what are you telling your clients who are in that position?
We're in the middle of a very long-term secular cycle. And if you're depending on that money, you're depending on the interest, you're depending on that, you're over 50 years old, you're going to need that in retirement, the rates will not move. They're going to stay down for a long time. I think Japan's a good example of that.
Well, there's a whole universe of income producing options. So we do have a lot of our clients in stock. A very small percentage right now. Typical client might have 20 or 30% in stocks. And if we have another recession and the stock market goes down another 10 or 15 or more percent from here, I want them to be able to buy more. So dividend stocks is absolutely part of the equation.
If you can live off of your portfolio and a 3 or 4 or 5% interest rate and not lose money the next time the market crashes, then that's what you should do.
You need to be able to invest so that no matter what happens, whether it's good, whether it's bad, you can still accomplish your dreams and goals.
See your articles in the USA Today, Forbes, Wall Street Journal. I mean, you're everywhere, man.
Well, good evening. I'm Anthony Saccaro, founder and president of Providence Financial and Insurance Services, located in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870 KRL Lays the Answer. And welcome to our first annual quarterly webinar. Now, I don't know if we can have an annual quarterly webinar, but that's what I'm going to call it. This is our first webinar, and I'm really going out and kind of sticking my neck out there in the spirit of answering questions for you, my clients, and for those guests and friends and family that you invited to be a part of this. And my goal in this is to answer the questions, and really one particular question that we've been getting on my radio show that I've gotten from my podcast, that I've gotten from you as clients, and that is, how do we deal with inflation? And that's what I want to spend our time talking about. So I'm going to just pretend it's kind of you and I sitting here, grab a chair, pull up a drink, or pull up a drink, grab a chair, however that order goes. You're going to see that I don't have any slides. This is not a pre-canned presentation. I just want to answer your questions and give you my thoughts as well, too, from what I hear on the radio. Now, I logged on about 15 minutes early. And I've used this setup, this same seminar system, I don't know, for years now. And I understand how it's supposed to look, understand what it's supposed to do, I understand where to go, I understand how to see the questions. But sometime between yesterday and today, they did an update, I'm guessing, because it looks totally different. And I have no idea how to see the questions at this point. So I have Jerry on, who was trying to figure this out. Jerry's going to be texting me, trying to figure out. I think he's trying to call tech support because I don't know how to answer your questions at this point. And you may have to give me some leeway to figure that out. So the wonders of technology. So I'm going to start by giving you some thoughts. And the way that I thought this would be structured, that I would spend 15 or 20 minutes or maybe 30 minutes kind of giving you some ideas, answering the most common inflation question. I really was hoping to be able to read the questions as they kind of came in and kind of let that help guide conversation. I didn't want this to be a monologue, but depending on what Jerry says, it may turn out to be a monologue. So if you see my eyes wandering and trying to figure out, am I just missing something? If I press the wrong button, I could just blow the whole place up and everybody else watching this thing. So I don't want to do that either. So let me start, and I'm going to let Jerry kind of text me and kind of get back to me and see if somehow I can figure out how to answer your questions, because call me crazy, if we're going to have a questions and answer session, then I should be able to answer your questions. So Jerry's going to be texting me along the way. But seriously, I do this for you. No client has ever fired an advisor because they communicate too much. And if I get questions from multiple people, I know that all of you are going to have the same type of question. And that's the reason that that I'm doing this. So this is going to be the first one we do. Depending on the feedback we get, it's going to depend on whether we do another one. I think there's over 100 of you online watching this now, and I'd love to get your feedback when we're done as well. And let me just put a shameless promotion out there for my podcast. I do 2 podcasts a week. My radio show that airs on AM 870 on Saturday mornings at 9:30. That radio show is aired as a podcast on Monday morning. So if you're not sitting at the radio on 9:30 Saturday morning, you can listen to that show on podcast Monday. And I do a brand new podcast on Thursdays for just the podcast listeners. And you can download the Providence Financial Retirement Show on your favorite podcast player, Apple Podcasts, Spotify, we're all over them. Or you can go to providencefinancialpodcast.com. But I'm doing everything I can to try to keep you informed and get that information to you so that you know what we're doing. You know what we're doing behind the scenes. So let's talk inflation. And forgive me if I'm looking around. I took some notes, so some things that I just want to remember to talk about. The purpose, the reason for inflation, the general simplistic idea of inflation is, or definition, is too many dollars chasing too few goods, right? Too many dollars chasing too few goods. It's a simple supply-demand equation. So if you have too many dollars and the goods stay the same, the price of the goods is going to go because there's too many dollars chasing them. On the other hand, if you have the same amount of dollars, but the supply of goods goes down, then the price of the goods is going to rise because the supply went down. Well, the challenge that we have with inflation now is the fact that we have both problems. We have too many dollars because we've just printed $7 or $8 trillion and gone from 22, $23 trillion in debt to $30 trillion in debt fighting this pandemic. And so now we have a lot of dollars that are out there that have infiltrated or been infiltrated in the economy, and that's increased the dollars. And you've probably heard that there's a shortage of supply, right? There's a labor shortage, there's a shortage of supply. So the reality is that there are too many dollars and too few goods at the same time. And normally one of these is enough to cause inflation. Well, we have both of them. We have less goods and we have too many dollars. And that's why we've seen inflation clock in recently at 8.5%. This last month, for July, it was 9.1% before that. And that has an impact on a lot of things. It certainly has an impact on you. It has an impact on you as a consumer. Things are going to be more expensive. And so the Federal Reserve steps in and they try to lower inflation. And you have to know that the Federal Reserve has 2 mandates. Their first mandate is simply to make sure that unemployment is stable. Well, we're there. We have a 3.5% unemployment rate, so there's no problem with the unemployment rate. But the second mandate is to keep inflation low. Well, how do they do that? There's a number of tools, and the one tool that they're using now is they're raising interest rates, right? They're raising interest rates. And that has a dramatic impact on you as a consumer, on you as an investor. If you're in debt, it's negative because credit card rates go up, home mortgage rates go up, auto loan rates go up, everything goes up. And that happens immediately. As soon as the Federal Reserve raises interest rates, then you're going to see an instant rising of your credit card rates or your home mortgage. That's especially, we've seen that, right? Now, if you're a saver, then interest rates are going to go up and you're going to start getting more. And that has somewhat of a lag effect. Doesn't happen right away. It's almost like if they're going to make money off of it, it goes right away. But if they got to pay you more, well, that's going to lag a little bit. They're not going to do that right away. So it's important to understand that even though rates are going up, they're certainly going to be implemented faster on the debt side than they are on the fixed income side or on the interest side. And the impact that this has is it has an effect on the 10-year Treasury. Okay? The 10-year Treasury right now sitting at not 3 point anything. I think it's somewhere around 2.5%, 2.75%, somewhere in that range. Don't have the number right in front of me, but somewhere 2.75%, call it. Okay? So 10-year Treasury sitting at 2.75%. Matter of fact, sorry, I need to get you that number. It is at 3.04%. So it's at 3.04%. Well, that 10-year treasury, is the benchmark that all of the other interest and dividend paying investments are gonna be compared to. The 10-year treasury is going to go up every time the Federal Reserve is going to raise interest rates. The Federal Reserve has raised interest rates from 0.5% at the beginning of the year to 2.5% now. So five-fold, 4 increases over the year, and they've raised interest rates up to 2.5%. And that has pushed the 10-year treasury up to a little over 3%. And that is considered the benchmark safe haven for everything else. Well, what do I mean by that? If you are willing to lock your money up for 3% for 10 years, okay, with no risk, it's the 10-year treasury is considered the no risk investment. If you're willing to lock your money up for 10 years, you could get 3% on your money. Okay? Now, would you then take any risk at all if something else is offering you 3%? The answer is no. You wouldn't take any risk at 3%. If you can get 3% risk free, why would you invest in a corporation, or why would you buy something else that has risk to it if it's going to pay you the same thing? So what happens is other companies, as they're issuing fixed income investments, these are preferreds, these are bonds, these are some of the things that you guys have in your portfolio. Well, what's going to happen then is they have to pay more. If there is risk, then they have to pay more than the risk-free amount. And that's going to be what's called the risk premium. And if a blue chip company, a company that no one is worried about, is going to offer a bond, let's say, well, if you could get risk-free for 3%, maybe they offer the bond at 3.5%. And because no one's worried about them, because they're very solid, no one's thinking they're going to go bankrupt. Apple's not going anywhere, right? Pick a big company, pick a Fortune 500. If you're not worried about these companies, well, they might be able to offer you a bond for 3.5%, and you might say, well, look, for another 0.5%, I'm not worried about it. I will be more than happy to invest in that investment for 0.5% more than what I can get on a 10-year treasury. Okay? So if a company is in trouble, a company has bad credit, there's not good maybe management there, or there's not good outlook for the company. Well, now all of a sudden that company, you wouldn't invest in a company like that for only 0.5% more. That company might have to offer you 7% or 8% or 10% or more to attract investors. So the reality is that as that 10-year treasury goes, so goes everything else, right? So goes everything else. And that's why the 10-year treasury is such a big deal when it comes to fixed income investments. Now, you know that fixed income investments are going to fluctuate opposite of interest rates, right? So when interest rates go up, when the 10-year treasury goes up, your fixed income investments are going to fluctuate down. And that's what you've seen. A lot of you guys have been with us for 2 years or less, maybe even a little bit more. Your portfolios are probably a little less than what you even started with 2 years ago. Our clients that you are watching, that you've been with us for more than 2 years, 3, 4, 5 years, your portfolios are still above water, well above water, because you've seen, you've had this income and dividends and interest all these years. It's been added, it's been growing, but it's certainly come down off of the recent highs. And I think it's important to understand that there's a significant difference between risk and loss, risk and volatility. Fluctuation doesn't mean you've lost money. And I get this question all the time from my radio listeners, even from you guys. Some people will say, well, I've lost money. I had $250,000 2 years ago, or 6 months ago, really more like 6 months ago, and maybe I'm down to 230. I've lost money. No, you haven't lost money. Your account has fluctuated down. That's exactly what has happened, is your account has just fluctuated down. And there's significant difference between fluctuation down and losing money. Your account's going to fluctuate. Every account you have is going to fluctuate, period. I don't care what you have. If you've got stocks, if you've got bonds, fixed income, it's going to fluctuate. And sometimes it's funny, when I take on a new client, I mention it's going to fluctuate, and they go, yeah, it's fluctuation, no problem. And 6 months later, they're calling me saying, hey, it's fluctuation. It's gone down. Yeah, it's going to fluctuate. And sometimes it's almost like when we hear it's going to fluctuate, well, they think it's going to fluctuate straight up. And some of you that have joined us years ago, it's fluctuated straight up, and then it's kind of taken a step back. But fluctuation means it's going to go both ways. Now, when you are in an income producing portfolio, as you are here, then despite the fluctuation, your income is going to stay the same. And that confuses a lot of people. Most people don't understand that. So maybe I'll take some time to explain. And I'm not explaining anything to you that unless you're friends and family and you've never seen me before, you haven't heard. This has all been on my podcast. We've had this one-on-one conversation, but I know a lot of times if it's explained differently, and even after I talk with people about it, it's trying to come at it from a different angle. So that's all I'm trying to do here. But your income's going to stay the same. So if you have a $100,000 portfolio and you're getting $5,000 a year of interest and dividends from that portfolio, your $100,000 portfolio could go to 90, could go to 110. Your 5,000 is going to stay the same. Most people don't think that. Most people think if it goes down to 90, then the 5,000 is going to go down too. What doesn't work that way, and the reason it doesn't work that way is because the investments that we have you in, for the most part, are going to pay you a dividend per share, not a percentage of the total. So if your $100,000 is going to pay you $5,000 per share, and you have 1,000 shares making up that $100,000, well, the value of the shares went down, but you're still getting $5,000 because the number of the shares is still the same. And I've explained that to a few of you recently who've had that question, and it's almost like the light bulb went on, like, okay, I get it. That's why the income stays the same, because it's an income per share. It's not a percentage. Now we turn it into a percentage. If you have $100,000 of an investment and you're getting $5,000 a year, well, the math tells us that you're going to be getting 5%. But it's not the 5% that is the constant. The 5% is the variable. It's the 5,000 that's the constant. So if your account balance drops from $100,000 to $80,000, you're still getting $5,000. But now if you're getting $5,000 off of $80,000 and you do the math, the percentage is going to be higher. Okay, so the percent is going to be higher. And I hope that helps in just understanding really how it is that fixed income investments are going to pay you the same income regardless of the fluctuation. So if you're living off your interest and dividends, as I always talk about, then does it really matter what the value of the portfolio is at any point? Doesn't matter, because you're living off the interest and dividends. Doesn't matter if your portfolio goes from 100 to 80, from 100 to 120, you're still getting the income. And a lot of our clients are in that situation. But a lot of our clients are not. A lot of our clients are reinvesting their interest and dividends. Now, here's the good news. If you're reinvesting your interest and dividends, when your portfolio drops in value, it actually helps you. Now, think about that for a second. If you have $100,000, or I don't know, let's make the number more reasonable, I guess. $1 million. It just makes the numbers more fathomable, I guess. You have $1 million. And you're getting $40,000 a year of interest and dividends. Well, if you're spending it, you can live off that. If you're reinvesting it, $40,000 a year, interest and dividends, you're not spending, you're reinvesting. Would you rather us reinvest when the price of your investments and the price of all the investments we're going to be reinvesting in is higher or lower? Answer is lower, because the whole goal is to buy low. And that's true when you are reinvesting as well. You want to buy low. So if you're living off your income doesn't change. If you are living off, or if you're reinvesting your income, then the fact that fixed income portfolios have come down is good. You get to buy low. I was having a conversation with someone a few months back, someone who got it. And this is a client of ours. He owns 4 or 5 properties, and he's got enough cash saved up to buy another property. And that's what he wants to do. He wants to buy another property, and he's getting a lot of rent from his real estate. And he and I were having a conversation. He called me up and said, "Hey, just want to run this by you. Want to see if you think it's a good time to buy real estate or not." And we were talking about that. And I basically said, "Look, I think real estate's high. But this was 2 3 months ago. Real estate's high. I wouldn't buy property now. I'm looking to personally buy another property as well. I wouldn't buy it now. I'd wait a little bit. I think if you wait, you're going to see a maybe 10, 20, maybe 30% drop. My personal feeling is maybe 20%, 30% drop. I don't think we're going to have another 50% drop in the market like we did back in '08. That's what happened back in '08. And this is what I was explaining to him. Same thing I just explained to you. And his response was very telling. What he said to me is this. He said, "Anthony, I would love for us to have another '08 scenario and for all my properties to go down by 50%. Why? All his properties are going to go down by 50%. Did he lose money with those properties going down 50%? No, his rent's going to be the same. He's still going to get the income, right? But the fact that all the properties drop by 50% in value, he gets to buy another property for half off. If your portfolios drop by 50% in value, you're going to get to reinvest at half off. Now, your portfolios are not going to do that. Fixed income portfolios are not going to be as volatile as stocks. We can't look at the stock market now and say that it's not going to go down by 50%. I could look at your fixed income portfolio and say it's not going to go down by 50%. Now, I say that, realizes this is being recorded, and we cannot say anything about securities, right? They're all securities. Securities are really not that secure. It's kind of interesting how that works. So there's no guarantees. We can't say, but let me put it this way. I don't see that coming anywhere close until COVID happened. And I've been a fixed income expert for decades. Until COVID happened, I remember 2019 and beyond telling our clients that I haven't seen a 5% or greater fluctuation in our clients' portfolios in about 10 years. That's really the case. They just don't fluctuate that much, and meanwhile you get your income. So they're pretty conservative. Now, again, these are non-stock market. We're not talking about the stock market portion of your portfolio. We're talking about your fixed income. They just didn't fluctuate a lot. COVID changed that, right? The COVID market went down 37%. The stock market, I should say, as a result of COVID, went down 37% in 37 days. The Federal Reserve lowered interest rates right away, and everybody was starting to panic, and everything went down. And that was panic selling. That was panic selling as a result of everything going down. So I can't say that anymore. Fluctuations have, or your portfolios have, in fact, fluctuated more than we've seen in years. They generally went down, and I'm going to talk general, and I got to be general because you're all a little bit different. Some of you have stocks, some of you have other stuff. You don't have stocks. But generally, most of your portfolios drop down by about 10 to 14%, maybe 15 on the really high side. Now, they've all come back about a third. And they've all come back about a third. So your July statements are going to be higher than your June statements for the most part. One question we've gotten so far has to do with the size of our national debt. So something we'll jump into in a little bit and how that kind of interplays as well too. So we'll do that. Where was I? Investing for income. If in fact you're living off the income, here's the key, then you can still get your income. If in fact you are reinvesting your income, then the fact that everything has come down helps you. It doesn't hurt you. And that's counter to what it is you've been told all your life, right? You've been told that if you look at your portfolio and the portfolio is down in value, bad. If your portfolio is up in value, that's good. That's just not true. Bottom line is this: if you're reinvesting your income, it's good. What I hope happens is that fixed income investments stay down for a little while, so that we can keep reinvesting for you while the prices are low. You're getting a discount on everything. The reality is nothing's going to go down forever. Nothing's going to go up forever. So the fact is that your price of your investments has gone down. The reason is because the Federal Reserve has raised interest rates dramatically, And that has had a negative effect on the total value of your portfolio, not an effect on your income. And really, if you are reinvesting, you should be looking at this as a good opportunity to reinvest and buy back in while things are still low. And I think that's important just to understand. There is a confusion, though, about fighting inflation. Jerry Skyped me a question from one of you about the inflation. How do we fight inflation? And this is the number one question that I've been getting for the last couple of months. I get this question from my radio show. I get this question from my podcast listeners. And you've asked me this question. That question just came up right now, according to Jerry, who's kind of feeding me questions back end. Doesn't look like there's a lot of questions. And that's what I've been asked on TV. How do we fight inflation? Well, there's good news and bad news. Whenever I get on TV or anyone on TV and says, well, you're going to buy real estate, you buy gold, you're going to buy stocks, it's going to fight inflation. It's the best inflation hedge. That is long term. That is not short term. And yet that's oftentimes not what you're thinking. When people ask me, how do I fight inflation? That means, how do I fight inflation tomorrow? How are my investments going to fight inflation in the next 6 months, 12 months? Here's the bad news. You can't. And you might be surprised, but you can't. Inflation is currently 8.5%. That's where we were. It was 9.1% in May. What investment out there do you know is going to guarantee you 8.5% every single year, no matter what? It doesn't exist. But at the same time, inflation's not going to stay at 8.5%. The Federal Reserve has made that absolutely clear. They're in a pickle. They're basically in a situation where they've got to decide, what do we do? Do we fight inflation and risk running a recession? Probably we're talking about a recession for a few minutes here too. Or do we just let inflation run rampant and not raise interest rates? And they've made it clear. Jerome Powell, the federal chairperson, has made it absolutely clear that they don't want a recession, but they're going to do what it takes to get inflation under control. Now, what you have to understand is that in getting inflation under control, that means that they're going to raise rates. Raising rates makes it more expensive to live. It makes it more expensive for consumers. It makes it more expensive for corporations. It's more expensive to live when they raise rates. And if life becomes more expensive, people spend less money. If people spend less money, there's going to be less corporate revenue. Corporations are going to earn less. That's going to trickle down to corporate profits earning less. And if corporate profits are going to go down, then the stock price is going to go down. And the gross domestic product, which is the output of the country, is going to go down. And if we have negative gross domestic product for 2 quarters in a row, that is what is a recession. So the government wants production to go down, gross output to go down, but they don't want to cause a recession. That's contradictory. You want production to go down. You want output to go down, because if people are spending less, then the demand for goods goes down. If the demand for goods goes down, the price goes down, and therefore you're lowering inflation. So the reality is that that's what they want. So inflation is not going to stay, in my opinion, at 8.5% or anywhere near this level for the time being, okay? Or for the long run, I should say. For the time being, it may, but for the long run, I'm not expecting that it's going to stay anywhere near this level. It's got to come down. And they risk running a recession, and legally, technically, we're in a recession. If you look at the Oxford Dictionary definition of recession, it's 2 negative quarters of GDP, 2 quarters of negative GDP growth. GDP, gross domestic product, that's, every time you buy something, a good or service, that adds to GDP. That's the country's economic output. If you have $100,000 of revenue coming in from your job, that's like your GDP. The country has revenue coming in, that's GDP. Every time you buy something, every time someone buys something, that's GDP. Well, if people are spending less, GDP is going to go down. And if we have 2 quarters of negative GDP, that is legally and technically and definitionally a recession. And we have just had our second quarter. First quarter was negative, and the second quarter was negative. We are technically in a recession. But now you have Jerome Powell, the day before this was announced, by the way, the GDP numbers, he comes out, no, we're not in a recession. And then the Bureau of Labor Statistics comes out and and says, no, we're not in a recession. Well, I'm an attorney, and there's rules, and there's a definition, and the definition says we are in a recession, but they don't want you to think that we're in a recession because if you think we're in a recession, you're going to quit spending money. And if you quit spending money, the price of the demand is going to go down, and then the price of things is going to go down, and corporate profits and revenues is going to go down, and inflation is going to go down. And they really want inflation to go down without all this other stuff going down. And it just doesn't make sense. I almost wish they'd say we want a recession, because a recession is almost what it's going to take to lower inflation. But they're not saying that. And recessions, like this R word, I've read articles, the R word, that it's not a big deal. There's good times, there's bad times, there's booms, there's busts. It's part of a normal economy, and yet they don't ever want to have another recession again. That's essentially what they're saying, is that we don't want a recession. Why? It's not that big of a deal. Now, think about it from a definitional standpoint. We were negative 0.9 GDP the second quarter, which legally puts us into a recession. So we're in a recession. There's not a question about that. They're trying to argue that, and they're trying to not put it out there, but we are. But what if GDP would have been 0.1%, not negative 0.9? There's not a significant difference there in output. But now all of a sudden, 0.1, we're not in a recession because it's positive, even though it's just barely positive. So I don't care that we're in a recession legally or not. I don't think it's a big deal that we're in a recession, but they want you to believe that we're not in a recession. And the simple fact is that we really want to be in a recession, because that's how you're going to lower inflation overall. But in the short run, it's going to be a fight. Okay. And the fact is that you can't fight inflation in the short run. Okay, what is the best inflation hedge overall? I'm going to tell you what the stats say. The stats say the stock market is the best inflation hedge overall. It's not gold. Real estate's a good inflation hedge as well, right? But the stock market overall has been the best inflation hedge. But if inflation goes up 8.5% and your stocks go down 20%, how good did that do for you inflation this year? It didn't. When we're talking about inflation on TV, or when I'm talking with you about inflation, it's what's a good inflation for the long run. Now, we've been fixed income specialists for years, and for many, many years, most of you know that we've talked about our goal in getting you income from your portfolio, dividends and interest, has been 4 to 5%. That's been our goal for a long time. We've been able to do that. You can't really, most growth advisors, all growth advisors, are not going to be able to do that. But it takes income specialists, and we've got the team of people in sound income strategies that's managing our client portfolios, focusing on income, 4 to 5% after fees. That's our target. That's been our target for a long time. Now, until 2019, actually until 2021, till the middle of 2021, inflation had been 2% or less. So if we're getting you 4 or 5 and inflation's 2, you're ahead. But that's not what's happening now. And we don't know where inflation is going to be. You remember when the Federal Reserve said that, it's just going to be transitory? They were wrong about that. And so they didn't do anything to try to curtail it, and then it got out of control. And they were so lackadaisical about that now they have egg on their face. So what they're doing now is they've gone the other way, and they're like, okay, no, we're not gonna make that mistake again. We're gonna get this under control. So they raised the rates 4 times this year. They raised it by a quarter point first, 50 points the second time, 70 points, 75 points the last 2 times. And they're going to make another probably 50-point raise here soon, and then maybe another raise after that. And who knows where it's going to go? But they're so bulldogged and so dogmatic in getting inflation under control. A lot of it has to do with the fact that they were behind the 8 ball to begin with. But if the market goes down in a year, this next year, and inflation is at 8.5%, that's not an inflation hedge. We're talking over the long run. Same thing with fixed income portfolios. If they go down It's not an inflation hedge. In order to have an inflation hedge, if inflation is 8.5% this next year, you have to have something that's going to pay you 8.5% this next year to stay pace with inflation. Please tell me what that is. But the funny thing is, this is not explained on TV, right? You hear someone talk about, well, stocks are a good inflation hedge, and you go put your money in stocks and lose 30%. That's not good. You don't want to do that either. So there's a short run inflation and there's a long run inflation. Now, we deal primarily with retirees, right? Most of you are retired, you're close to retirement. And if you could get 4 or 5% on your portfolio and inflation is only 2, great, you're ahead. You've got a real rate of return of 2, 3%. You're in good shape. And this has gone on for the last 10 years. We haven't had to worry about inflation. Income portfolios have been great. But if inflation is going to be higher for the long run, we then have to make some changes. And when we have, and I've talked about some of these changes in my YouTube videos. By the way, I didn't mention YouTube earlier. If you want to stay in touch with us, if you're not a follower of us on YouTube already, follow us on YouTube, because that's how I'm going to communicate with you. You know, when something happens in the market, as much as I would love to, pick up the phone and call all of you and let you know, hey, I think you should be doing this, I'm not going to do that. I'm going to put out a video and then invite you all to call me. But the reality is that we haven't had to make any huge adjustments for inflation until now. So there's a couple of things that we've done to hedge against inflation for the long run. It doesn't mean it's going to hedge against inflation for the next 6 months or a year. This is for the long run. So what have we done? There's 2 primary things. One, we've added real estate investment trusts in the portfolio because it's real estate, and real estate's generally a good inflation hedge over the long run. And stocks. Stocks have generally averaged 8 to 9% over the long run, and you throw in the dividends and you could be at 10% plus over the long run. So not bad inflation hedge as well. But anything can happen in the next year. Real estate, which is a great inflation hedge over the long run, but if you go out and buy a home today, chances are in a year you're going to have lost money on that home. So if you've lost money on the home and inflation's up and your home value's down, that's not inflation. That's not a hedge. It's not a short-term hedge. And I've had this conversation with several of you. Several podcast listeners have called in that I've talked to, radio show listeners. And it's almost like when I explain this, the light bulb goes on. They're like, I never thought about it like that. But you don't hear that on TV. And it's kind of frustrating because there is no inflation hedge at 8.5% because there's nothing out there that's going to guarantee you 8.5% in the short run. And I hope that makes sense. This is all long-term investing. I hope it makes sense. So what do we do? And that's the number one question I've been asked on the interviews I've done recently, which are all on our homepage, by the way. If you haven't visited our homepage, you haven't seen my interviews, go to our homepage, providencefinancialinc.com. You can watch all my interviews there. They're pretty much there within a few days after I do them. And while you're there, click on the YouTube channel and just click subscribe, and you'll get all our YouTube so that you stay up to date with these things as they happen. But what do we do? Number one question I get asked. My suggestion is invest for what you can count on. Invest for what you can count on. If you own a basket of stocks, I don't know, let's say you own $1 million of stocks. What can you count on that $1 million being there in a year? What's the value of your stock going to be worth in a year? We don't know. I have no idea to guess. It could be worth half, it could be worth double. Now, most people don't think it's going to be worth double. Anything, it could be worth half. History tells us that it could be worth half. We don't know. If you buy a home right now, based on the value of the home, what's that home going to be worth in a year? No idea. No idea. If you buy anything right now, we don't know what it's going to be worth in a year. So it's a guess. But if you buy things that pay income, you can count on the income. So if you're getting 4 or 5% on your portfolio, you can count on that every single year. Is it going to stay pace with inflation? No, not in the short run. And if inflation stays at 8% in the long run, it's not going to stay pace with inflation in the long run. But tell me what is. And it's almost like you get these people on TV that are saying, oh, you got to do this, and there's a magical thing, and then people go do it. It's you have to understand that that's not the way it is. You have to invest for what you can count on. And in income portfolios, you can count on the interest and dividends. That's what you can count on. If you're getting 4 or 5%, you can count on that. And that's what I've told a lot of people, podcasts that I'm guest on, again, the interviews I've done and so on. What I've talked about on my radio show a lot. Invest for what you can count on. So we've made some changes, sound income strategies. A lot of you have added some stock to your portfolio, and a lot of you haven't. I've made the recommendation because long-term stock is generally a good inflation hedge. I think now because the inflation is higher than what we can get, we have to make some changes, and I think you have to make some changes too over the long run. Now, the stock market was officially in bear market territory. The S&P 500, it was down 23%. Now, as we sit here today, it's down 13%, so it's come back 10%. So buying stocks today isn't as good of a deal as it was 4 weeks ago. We had 4 good weeks, and then last week broke the stream, broke the cycle. So, but we're still down 13%. And what you've seen me say on my YouTube channels, on my YouTube videos, if we know that you've got that income coming in, then we know we can count on that income, regardless of what's going to wind up, what inflation is going to be. You can count on the income, so you have to invest what you can count on over the long run. Now, there's also such a thing as a personal inflation rate, and your situation calls for how you're going to deal with it as well. You might have a couple $1,000,000, and maybe you don't need anything out of your portfolio. Maybe you're living off your pension, you're living off your rental income, you don't need the money at all. Well, is the 8.5% inflation really going to affect you? No. Yeah, maybe you're going to need to spend some money later, but it's not going to affect your lifestyle. And it's important to know that your personal situation as well too is very important when it comes to doing this income planning and it comes to doing this financial planning. Very, very important. So let me just take a few minutes and talk about the Inflation Reduction Act that really a lot of economists have called it the Inflation Irrelevance Act, because when you look at inflation, they really say that when you look at this entire act, it may actually be that it only affects inflation by 1/10 of 1%. So shouldn't be called the Inflation Reduction Act. It could be called the Deficit Reduction Act, because when you look at the numbers, it's supposed to reduce the deficit by about 10%, by about $300 billion. But you have to look at how they're going to do that as well too. It's not really the Inflation Reduction Act; it's the Deficit Reduction Act. But even in some ways, that's smoke and mirrors as well too. So the total revenues that this thing is supposed to raise is 737 billion. I'm referring to my notes, and there's total investments of 437 billion. And what I want to know, and by the way, that's a $300 billion surplus they're saying. So it's going to reduce the deficit by $300 billion. But when I look deeper, I'm like, what is it going to have to do on the economy? What's it going to have to do with the stock market? So a couple things I want to point out. The number one revenue raised, okay, total revenue raised, 737 billion. The number one fact, the number one revenue raiser here, $222 billion, is going to be raised by corporate tax. Corporate tax. They're going to raise corporate taxes. Now, these are on large corporations, but all the corporations that are blue chip corporations are large corporations. If they're going to raise tax on corporations, corporations are going to be able to spend less. They're going to have less money to spend. If they have less money to spend, they're going to have to lay off people. If they have to lay off people, then there's going to be less jobs. And if there's less jobs or more jobs, less workers, more people that are unemployed, unemployment rate's going to go up. And that's not going to be good for our economy as well, which means that it's going to have a negative impact on the stock market because they're raising rates on the corporations. So that's not really looking good. And I think I can also then tie that back to what we talked about as far as recession is concerned too, because of the simple fact that we're legally in a recession. But the reason that a lot of individuals have said we're not in a recession, they're trying to downplay it, is because the unemployment rate is so low. We're at a 3.5% unemployment rate. Right now, there's 1.8 jobs available for every worker. Last numbers I saw, there was, I think it was 10.7 million jobs available and like 5.5 million workers, or somewhere in that range. And in order for the recession to really be a recession, according to these individuals, these other economists, unemployment has to get to like 6%. And we're far from that. The unemployment number really has been low and with so many jobs available and so few workers, but so many jobs, the fact is that even if people get laid off because corporate revenue or corporate taxes go up, there's so many jobs they could go find another job. So it's really not going to affect unemployment. And we're going to have a hard time lowering inflation as long as there's high unemployment. Because if someone can go out and they know that there's plenty of jobs available, they have the ability to go look for another job somewhere else and ask for a raise in the process. And a lot of companies are having to give raises just to keep their current employees. And by the way, if you've got these big Fortune 500 companies that are going to be taxed at 15%, and by the way, they got to increase everybody's wages so that they don't have a labor shortage, that all is going to get passed on to you. That's also another reason why there has been such huge inflation. Right? So I think that's important to understand as well too. So I think inflation is here for a while, but I don't mean a couple months. I mean, but I also don't mean a couple years. My best guess on inflation is probably another year or 18 months or two, but we don't know. Okay? We don't know. What we do know is that you can count on your income. One more thing that we can talk about, and then we're going to call it a wrap with this. Okay? And that is that the bond market is a good predictor of where the stock market is likely to go. And we now have an inverted yield curve for probably the last 4 or 5 weeks or so, and it's a pretty significant inverted yield curve. And so what's an inverted yield curve? Well, if I had my whiteboard in front of me and you guys are all sitting in my office in my conference room, I would tell you that that a normal yield curve goes like this. Okay? So what that means is that if you were to buy a government bond, or any bond really, but let's talk about government bonds. If you were to buy a government bond that is 5 years versus a government bond that is 10 years, which would you think should pay more? The 10 year should pay more than the 5 year because you're committing your money for a longer time. The 20 and the 30 year should pay more than the previous years because the longer you commit your money, the more interest you're going to earn over a period of time. Okay? Now, what's happened is the yield curve looks like this. That's what an inverted yield curve is. Well, let me give you some numbers. The 2-year treasury today is paying 3.38%. That means you could lock your money up for 2 years, 3.38%. Or you could lock your money up for 10 years and get 3.04%. That's a third less. So what would you do? Lock your money up for 2 years and get 3.38, or lock your money up for 10 years and get 3.04, a third less. Or you could lock your money up for 30 years and get 3.25. So let me get this right. I could lock my money up for 2 years and get 3.38, or I could lock my money up for 30 years and get 3.25%, which is less than what I could get for 2 years. Why on earth would you lock your money up for 10 years or 30 years if you could get a higher rate for just locking your money up for 2 years? Here's why. Because you believe that in 10 years, or you believe that in 2 years, you're not going to be able to get 3.04 anymore on the 10 year. Or you believe that in 10 years, you're not going to be able to get 3.25 anymore on the 30 year. If you believe that the 10-year treasury is going to go down, then you'd want to lock it in at 3.04 for 10 years. Because in 2 years, when your 3.38% bond matures, you're not going to be able to get 3.04 anymore on the 10 year because it's going to go down. Same thing for 30 years. If you want to, invest your money for 30 years and you believe that in 10 years, in 10 years that you won't be able to get 3.25% on your money for another 20 years beyond that, then you'd lock your money up now for 3.25 for 30 years because that might be the only opportunity to do that. They say the bond market is smarter than the stock market, and this is proving it. Well, what does this tell us about the stock market, this inverted yield curve? Well, bonds are a flight to safety. And without doing all the math for you, take my word for it that when the demand for bonds goes up, that's because people want to buy bonds, then the price of the bonds go up and the yield goes down. Right? So if we're saying that a 30-year treasury is paying 3.25, Well, if the demand for bonds goes up because people want to buy bonds, well, then that 3.25 for 30 years is not going to be 3.25 anymore. It's going to go down to 2.75, 2.5, two maybe, and be down there because the demand for bonds has grown. So what's going to cause everybody to want to run to safety? How about a stock market crash? The stock market goes down, people are going to want to run to safety and people are going to want to get out of the stock market and start buying bonds. It's going to drive the demand for bonds up. And it becomes a vicious cycle where people are starting to panic and want to get out. And if we don't get inflation under control, and if or when some of these taxes start to come into play, and the fact that workers are being paid more and the recession is here and people start getting worried, then the fact is there's going to be a flight to safety, and the flight to safety is going to come from stocks. And if people are selling their stocks off and buying bonds, what's going to happen to the stock market? I know it's a lot. All of that is what the bond market is telling us. And most of the times, there's few exceptions, but most of the times when there's an inverted yield curve, it leads to a stock market that it leads to a stock market, or it tells us that a stock market's going to have some major problems ahead. And that's what this is telling us now. That inverted yield curve is telling us now that we might be able to get more at 3.25 for 30 years than we'll be able to get in just 2 years. Right? And we are already in a recession. I think at some point, the Bureau of Labor Statistics is going to have to acknowledge that we're in a recession. I think Jerome Powell is going to have to acknowledge that we're in a recession. They can't hide it forever. We're legally in a recession now. The unemployment rate's eventually going to go up. Inflation's going to come down, but people are going to get worried. People are going to wind up selling, and I think that it's going to get worse before it gets better. Now let's tie that all back to your income portfolios, and then we'll call it a wrap. Well, the Federal Reserve has just raised interest rates a lot, and that's had a negative effect on the value of your income portfolios. Right? They've gone down. That's why they've gone down. But the reality is that if some of this stuff starts to happen, if the bond market is right, we start to have some. The stock market starts to have a problem and maybe starts to snowball, and maybe we go 20 or 30 or 40% down from here, which is highly likely. A lot of people think that's going to happen. If that happens, then what is the Federal Reserve going to do? Well, Federal Reserve is going to lower interest rates. And if they lower interest rates, what's going to happen to your income portfolios? They're going to bounce back up. So what's happening is, for those of you that are reinvesting right now, you're reinvesting your income, and we're kind of spring loading. We're kind of like, that pressure is there. And I've seen this before. I was an advisor in 2001 when I saw this. I was an advisor in 2008 when I saw this. And what happened back in both of those time periods is we were reinvesting, and then all of a sudden the Federal Reserve, and 1 year you look at your portfolio, it's like, wow, I was up 15%. Well, that's what I think is happening now. Right? I don't think that we've seen the worst for the stock market. I think the worst is ahead of us. Now you might say, well, then let's get all out of stocks and go sell all our stocks and buy later. No, because we don't know for sure. Remember, everybody's giving you their opinion. No one knows for sure. So the reality is, I don't think the worst is over for the stock market, but I think that we might have seen a floor on income portfolios, okay, going down. I don't think they're going to go down much more. If anything, they've already bounced back a little bit. And that's because the income portfolios and stock market is all expectationary. It looks ahead at what it thinks is going to happen. If a person or the country thinks that, investors think that a company is going to go bankrupt, well, the reality is that stock becomes worth zero long before they ever file bankruptcy, because people expect that it's going to go bankrupt. No one wants to buy the stock. Same thing with fixed income. It's expectationary. It looks in the future. And right now, the new interest rate increases that are going to come, whether it's 50 basis points or 75 basis points, and there's going to be like 2 more raises. That's kind of what's been forecast. If that happens, that's all built into the fixed income market. Okay. So I don't think those are going to affect your fixed income portfolios. But what if there's a surprise? That could. What if inflation doesn't come down? And by the way, inflation lags a few months. So when the Federal Reserve raises interest rates, it doesn't affect inflation tomorrow. The fact that the inflation came down from 9.1% to 8.5% is a result of the knowledge that the Federal Reserve was going to start raising interest rates several months ago. So what they're doing today is going to have a lag effect 3 or 4 months down the road. And all of that, I think, is built into the fixed income portfolios at this point, where I don't think they're going to go down much more. But what if inflation is still stubborn? What if unemployment doesn't go up? What if the Federal Reserve comes out next time and says, "Oh, we're not going to raise by 50 basis points," which is, I think, what the consensus is now. We're going to raise interest rates by double that. Yeah, that could be a surprise, and it could cost more. Could cause fixed income portfolios to come down a little bit more. But absent a surprise, I really don't think that there's too much more downward on a fixed income portfolio. And when the stock market starts to have some problems, and when the Federal Reserve starts to lower interest rates again, I really believe a lot of you are going to see your portfolios pop and be spring loaded. That spring load effect is going to take place. And from the standpoint of you and looking at your balance and seeing it up in value and just having that emotional comfort of knowing that your balance is back up, I think a lot of you are going to be happy. Personally, it doesn't bother me. I don't care. If your portfolio is down and you're reinvesting, take advantage of that. It's going to fluctuate. And when it fluctuates back up again, you're going to feel better, but now it's going to be more expensive to reinvest. It doesn't matter when you're living off of income. So at the end of the day, you can't fight inflation for the short run. You can fight it for the long run. That's why we've started recommending some stocks in your portfolio for the long run. That's why we added real estate investment trusts into your portfolio. So we're staying with it. But for those of you that are looking for an 8.5% return this next year, because that's what inflation is, it's just not going to happen. But I really hope that what I've shared with you has maybe opened your eyes in a few things and maybe just enlighten you a little bit. And I would love, we don't have a formal survey system for this. We do send out surveys every now and then. But if you wouldn't mind to send me an email and just let me know if you like this, if you didn't like this, send me an email and let me know good, bad, what you would like to see different. Depending on your feedback, I am most likely going to do this again in a quarter, which means probably sometime in November. And just stay tuned for that one. And I promise you, next time we do a Q&A, it will actually be a Q&A. So if you're a client of ours, I appreciate your business. Thank you for your trust. Thank you for your loyalty. A lot of you have been with us for a decade, 15 years. If you're new, if you're a friend or family, you were invited, you want to learn more about us, please go to Providence Financial Inc. You'll learn everything you want about us. If you want to have a quick conversation with me, there's a place that you can put your information in, let them know you want to have a quick conversation, and we will get you set up. But meanwhile, it's been good having a question and answer monologue with you. I wish everyone well. Have a great evening. God bless.